Another pause in RBA rate hikes invites the obvious question: how close are we to the top in the tightening cycle? Our latest views as we dive into a new financial year. The welcome pause in the hiking cycle at 4.1% in July was made possible by the latest monthly inflation data, showing annualised CPI had fallen from 6.8% to 5.6% in just 1 month. Although the RBA's strong language after last month's hike, warning about tight labour markets and high core services inflation, left opinions finely balanced on the latest decision. The pause after 4% of rate hikes, 3.25% of them in the last financial year, gives the Reserve Bank the opportunity to compare the monthly inflation data for May with the full quarterly figures to June 30, which will be released at the end of the month. It will also give them another read on labour markets on July the 20th, after the remarkably strong result for May when unemployment fell to 3.55%. This will be crucial for the August RBA meeting as Philip Lowe continues to be vocal and insistent that, in the absence of productivity growth, higher wages, driven by low unemployment and tight labour markets, will only feed through to unit labour costs and so directly back into inflation. As a result, we still warn that another hike to 4.35% is imminent, and only a very favourable read from the quarterly CPI data would avoid this outcome, or perhaps a jump in the unemployment rate to demonstrate that higher interest rates are slowing down the economy and demand for jobs. The other factors for the RBA board to consider will be offshore developments after the pause in rate hikes in the US, but the 50 basis point jump in the UK, and locally trends in household spending after the 0.7% jump in retail sales in May, which, as the chart shows, is still below its peak 6 months ago, but is showing some resilience. Household budgets remain under pressure as monetary policy continues to bite, although house prices have crept higher again, up another 1.1% in June. Weighing up all of this, we still expect at least one more RBA hike, and recession risks have risen markedly since April. But repeating our comments from a month ago, even if this is the peak in official rates, relief via rate cuts remains well down the track, as we've consistently warned throughout the year. And lastly, stock markets globally are still riding a wave of AI exuberance, shrugging off any thoughts of recession and placing faith in technology driving the next upswing, despite risk-free rates rising to their highest levels in a decade. And that's the market update from Leveraged.